This is the Domain Magnate Show, where you'll learn everything you need to know about buying, optimizing, and selling online businesses with your host, Michael Bereslavsky.
Good morning from sunny Chiang Mai. This is Michael Bereslavsky, and in this special episode, I'm going to sum up 2021. So I'll share my views and experience this year, give you a quick market overview of where we are right now in terms of opportunities for buying online businesses, in terms of current market trends in different types of online businesses, as well as give you some updates about the main Magnate, where we are currently, what we are focusing on, what our plans. Also share some lessons I've learned this year. Give you some update on the performance of our funds, our acquisitions and sales, and a lot of general advice on the industry and the best opportunities to pursue right now. So let's dive into it. First of all, I am currently in Chiang Mai, Thailand, where I've been for the past few years now. And we've gone for quite a few changes this year in the main Magnate. The market as well had some really interesting trends developing and growing. So among those trends, I would say several of the biggest ones are, first of all, the growing multiples. What we are seeing right now is that the multiples across the board for all types of businesses are just going up and up. And I think now we are at the point where the expected returns from like an average acquisition of an online business might actually be lower than what the current average prices are. So we are at the point the price for an average online business is actually higher than what the expected cash flow return would be based on, this is just based on my subjective analysis from hundreds of deals and many of the people in the industry and the deals that I know about. At the same time, I think the market still presents a lot of really amazing opportunities. So I'd like to go briefly over the different types of businesses, first of all, to give you a quick update. In content sites, we are seeing a growing gap between the listing prices and the sales prices. So the sales prices, I believe, are still somewhere in the like mid 30s up to like 40x as a multiple on revenue mostly, but for bigger sites, it's usually a multiple on profit, which is another interesting trend. So we've, at the main Magnate, we've sold most of our deals at around like 37, 38x on the profit, generally on the revenues for smaller content sites and bigger ones as well. And we've acquired also around similar rate. We've been mostly paying around 36x multiple on content sites, which is 3 times the annual profit. We aim to buy based on the profit on profit, generally multiple on profit rather than revenue. With SaaS businesses, the trends just going wild. The multiples are skyrocketing, especially the higher you go. It's easy to find ranges of 5x, 6x, 7x. I've seen some crazy deals happening where people pay 10 times of annual profits, or something like 3 times annual revenue, like revenue, not just profit, because there is a really growing amount of capital in the SaaS business, in the SaaS space. And people are easily excited about investing in SaaS businesses because it could be the next Facebook, or it could be the next Uber or whatever. So there's a lot of capital flowing. and there are many funds that are looking for deals. So and there is also cheap capital from SBA loans and so on. So people are able to go and buy these businesses with a lot of cheap capital. And that is just driving the prices up and up. So we've still been able to find several good SaaS deals that we can acquire at reasonable multiples of about three times annual profit or a little more, but it's getting increasingly difficult. Recently on our podcast, we've also interviewed someone who acquired a SaaS company for 5x, and he thought it was really a great deal because it's a growing business, 5x on the annual profit, which I think is pretty high. But of course, it could be worth it if the business is really great. You can look it up. It's episode 15. So that just shows you how high the multiples currently are. For e-commerce businesses, for non-FBA e-commerce businesses, the multiples are actually somewhat reasonable, I would say. You can still find deals at 2x or 3x annual profit, which is good. For FBA, I think the prices right now are already pretty high because, again, there is so much capital, so many funds like Thrasio, which raised over $2 billion now to buy a couple hundred FBA stores, and there are many other similar funds. So I would simply not recommend entering that space right now unless you know where and how to find a good deal and have some advantages in that. I think e-commerce businesses present much better opportunities rather than FBA or Amazon-based e-commerce businesses strictly. There are also interesting opportunities in services businesses. Of course, in services businesses, it's all over the place. It could be productized services business or all kinds of agencies that you can acquire. And the multiples for prices can be all over the place. There are no rules at all. So you have to be very careful and know what you are doing, but you can certainly find interesting opportunities. So that's the first trend, growing multiples across the board. The second trend is there is lots and lots of capital and more pouring into the industry. I think this is going to continue for a bit until the trend will probably stop and reverse. We are seeing also the EF Capital from Empire Flippers is doing well in terms of they've been able to raise quite a few funds now. We don't know the performance yet because it's too early to see the results, but they've raised quite a few different funds and the funds acquired quite a few different businesses. So it'll be very exciting next year to see some first results of how the first rounds are performing. So there is a much easier way now to invest in funds, which is a new trend as well for most buyers. We are also seeing that the buyers are becoming more educated, more experienced, more knowledgeable. There is still a huge gap in terms of knowledge in the industry among the buyers, but we're seeing more and more different programs and opportunities for people to go and learn about acquisition entrepreneurship, and that is great. We're also seeing quite a lot of risks, especially in the organic traffic space with SEO sites. So many high-risk websites with dodgy SEO and with Google updates coming up every couple of months now. The risks are becoming higher and higher. So that's it mostly in terms of trends. For opportunities, there are still quite a few areas where opportunities exist. One of them, I would say, is through leveraging capital, cheap SBA loans, small business loans in US, as well as many alternatives in other countries. Cheap capital. There are also multiple companies now that are such as Bupos, that are offering you loans for acquiring an online business, loans that don't require personal guarantee, and you can just acquire a business and then they charge their payouts from Stripe, for example, or whatever you're using, or if you're using Shopify from the platform directly. So it's getting easier and easier to go and buy a business with other people's money, as well as EF Capital we mentioned, and all the other funds and groups allow people to go and leverage their money. So with EF Capital, you are able to get about 4 or 5x leverage, so that as an operator. So there are many opportunities now for operators there where they could benefit from that. I'm still seeing a lot of opportunities in smaller content sites. If you are entering the market, I would say this is the best place to start. Buying a smaller content blog, content site, finding some opportunities where they are under monetized, available at a low multiple, and you can just add some affiliate programs, improve, grow, add some better SEO, build funnels, whatever. And for example, check out our episode 51 with Chelsea, who explains how she does that. Flipping sites is still one of the best ways, one of the best opportunities to make money right now. There is another interesting opportunity emerging, which is buying solid, very solid content websites that have great history and growth potential. And I'm seeing quite a few of those, especially on Flipper, surprisingly. Just the other week, we had a website that someone was selling, it was an incredible website, earning close to $1 million per year. So it was just above our buying range. But the site was, I think, 15 or 20 years old, and all completely organic, with millions and millions of high quality backlinks. And sites like that are very rare, and we couldn't find them before. But now the trend is coming that we are seeing more and more people who have these really established websites that we've had for a long time, and they have no dodgy SEO, no risky stuff, and they're selling them now. Of course, the prices are relatively high, multiples are relatively high, but I think those present an amazing opportunity if you have quite a lot of capital. This is what I would go for, the sites that have been around for 5-10 years with stable or consistently growing revenue and traffic. And if you know what you're doing, or even if you don't, frankly, those can be pretty simple to update and keep improving, and the risks are pretty low. Another interesting opportunity is in the content space again, is finding sites in some risky areas. And I don't mean risky as in illegal, I wouldn't advise that, but risky as in something that people might consider that it's not completely legal, but it is, such as growing weed, growing marijuana. So that's now completely legal in the US and many other countries as well. So while it still has sort of a bad reputation, so if sites like that would often not attract enough attention among buyers, so the multiples of buying price might be relatively low, so you might be able to get a really good deal because of that. Because most buyers, they look at it and they see it as a red flag, and they think that it's best to go for a mainstream niche, which is not true, by the way. So that could be a really interesting thing to explore, and you can find many more ideas of this kind of gray areas to explore acquisition opportunities. In SaaS businesses, there are practically no opportunities, except maybe a service business that you could convert to a productized service business and then sell subscriptions and call it a SaaS business, which is quite reasonable. That's possible to do. But I would not advise going specifically after a SaaS business to acquire. On our private mastermind, we have many people from different private equity firms who actually specialize in buying SaaS businesses. And I can share with you that most people are complaining now that it's really difficult to find deals, and especially deals that are somewhat reasonably priced. services businesses could be a very good idea to acquire, especially ones that have a really strong brand and well-established channels of traffic, not for something like the owner's personal network, but organic traffic, maybe really working well, paid traffic, and so on. So this kind of services business could be really interesting, especially the ones in the range of, I would say, from maybe $100,000 in annual revenue up to like $500,000 in annual revenue. This is the range where usually it's owner managed, owner maintained with a small team, and there are many improvements that can be made. As once the business grows further, that can be more complex and more sophisticated. Then in terms of e-commerce, I would say the best opportunities are either looking into drop shipping. And by the way, check out our podcast episode number 54 that where we had a chat with Ian, who shares his experiences with buying dropshipping sites. He's quite he was quite good at it. And I think dropshipping sites in general could be quite a good opportunity, often overlooked by investors and acquirers. But of course, you have to know what you are doing, because this is really a type of business that you cannot come in without quite a bit of prior knowledge. Also, e-commerce businesses that have a strong brand and several channels of traffic and sales, they could be a really good acquisition, especially the ones that have some kind of a moat around them, some kind of advantages among the competitors. A few things that are really important to keep in mind nowadays than acquiring an online business. First of all, especially with content sites, it's really important to review the expenses. Nowadays, the trend that we are seeing is people always underreport expenses. So what we started doing at the main Magnate is really estimating expenses from our end. How much are we going to need to spend in order to manage this site, just to manage and maintain it, even before we want to invest in growth? And that gives us a good idea, and that's something I would recommend to everyone. If you acquire a business, of course, you review the P&L, the expenses, but then you ask yourself, if I'm managing this business, how much do I need to spend to really operate everything? And as you review all the different things that need to be done on a recurring basis, you can get a pretty good idea of what the costs are. And most of the time, it's going to be quite a bit higher than what the reported costs are. So pay close attention, because that could be a very big difference. And then it really affects your acquisition multiple. Let's say you are looking at a business that you can acquire for 3 times annual profit, but in reality, you would have to spend at least 25% more of the profits in order to maintain the business. So that means that it's actually not a 3x, but over 4x that you are paying on the profit here. So keep those kind of things in mind. Also, important things to avoid is really high risk, dodgy SEO practices now. So lots and lots of people are doing PBNs still, private blog networks, where they have large networks of websites that are linking to the main site. And or they might be doing a lot of guest posts, a lot of paid acquisition, paid backlinks. And the typical response we see is that people say, well, it's worked so far. I've been doing it for a very long time and it works very well. There is no problem, no risk. But it all works only until the next Google update, only until Google finally catches up and just the site will just very quickly drop. And again, we've seen sites lose 80-90% of their traffic for these kind of things. Additionally, things like repurposed domains. People often buy domains, expired domains from auctions, and then build a new site on them, which is not as relevant in order to take advantage of the previous backlinks, of the previous SEO power. And since we review hundreds and even thousands of sites, and we get access to a lot of data through the Google Analytics, through the P&Ls that we receive, and we often follow up. So I've had this privilege to be able to have access to hundreds of different sites and being able to track them over a period of a few years. And generally what I've noticed is pretty much any site that was using some kind of higher risk SEO techniques, be it repurposed domains, be it like PBNs, or doing really aggressive SEO, pretty much all of them have been wiped out over the past year or two. They've lost most of their traffic. When we look at Google Analytics, it's just way down. So the conclusion is very simple. Just avoid that. Avoid anything that looks like it can be remotely risky in terms of SEO. And from our end, one of the criteria we have is we review all the backlinks, of course, we review the content, and we just don't buy sites anymore that have aggressive SEO done to them. So we generally just don't buy websites from people who are professional SEO people. And because no disrespect given here, there are many people who do very high quality SEO, but generally the risk is just much higher. So they put a higher premium on websites that have been built out of passion, out of interest in the niche, in the industry, which is much better. You may notice me waving my hands around. There are just many mosquitoes here. One of the downsides of living in a natural place. So more important things to keep in mind is these days, more than ever, you really need to utilize some expert help especially if you're first acquisition. So if you don't have as much experience in acquiring businesses, I would certainly recommend working with someone who can provide some counsel, some advice, or simply start small and buy a few smaller businesses, manage them until you feel comfortable enough that you can go for a bigger deal. And again, deals matter a lot. So being opportunistic is way more important now than even before, because there could be such a huge gap between finding a good deal, a business which is not necessarily about price. A good deal is a business which has relatively reasonable risks. They don't have any disproportional risks. A business that has some opportunities for growth. And it could be a little challenging to really understand the risks and understand the opportunities, because first-time buyers, beginners, they might look at the businesses and think, oh, this is a huge industry, this is a huge niche. Like the competitors are public companies, and so I could probably expand this site as much as possible. Well, in reality, it's the opposite is the truth in most of the cases, because you cannot compete with those huge competitors. So you only have your tiny sub niche of that industry that you might be able to get some ranking, to get some sales, but you would not be able to go and expand further because it's just way too competitive. So it's really important to pay attention to those small details. And similar to the risks, there are many different opportunities. The risks come from not only opportunities, but many different channels of risks that you have to be aware of. And for me, when I look at the business, I usually just like look at it in the first few seconds. I would know, okay, these are my main risks, these are my main opportunities, because I've seen thousands of similar sites. So I just know that from experience. But as you are doing it early on from your first few attempts, the best way to do it is just have a big checklist, review many businesses, learn as much as you can, and sort of go through a checklist, and then you tell yourself, okay, I'm going to check this now, then I'm going to check this, then I'm going to check the backlinks, then I'm going to check the topics, the keywords, then I'm going to check the quality of content, then next I'm going to go and check who are the top competitors and what are they doing, and so on. And initially that keeps you more organized so that you don't forget important stuff. Now, one of the main questions I usually get is, how do you find deals how do you find good deals really in such a market there? There are very high prices already, there are very high multiples, and everything seems to be overpriced. So how can you actually find good deals? And first of all, we've still been able to find consistently pretty good deals all throughout even this year with the Magnate. But we have redefined what a good deal for us. Previously, a few years ago, a good deal for me would have been a very low buying multiple, low price, and seeing some opportunities for particularly immediate improvement. Now this is becoming very rare. So now the good deals are more like sites that are stable and solid, that have lower risks. This is the biggest criteria right now. This is the most important thing for me right now, to look at lower risks in websites. And that if it's organic traffic that comes from SEO, additionally, it comes from understanding the competition, understanding the advantages of that business, and then looking at opportunities for improvement. And with content sites, it's usually pretty straightforward. You can see how it can be monetized better. You can see some on-page optimization, or maybe you can see if it's ranking somewhere like on the second page, and you can improve it a little bit so it comes up to the first page of results in Google, and so on. So these are all opportunities that you can estimate pretty quickly and pretty accurately. Also, it's important to look at the deal structures. Nowadays, nearly all the deals we are doing have some sort of elaborate deal structure that includes either an earnout or seller financing. And that could be as little as 10 or 20% of the deal, and sometimes maybe even up to half the deal is seller financed. Meaning that, for example, let's say we are buying a business for $300,000, and we might pay $150,000 after like a 1 week inspection period, and then the rest is spread out over 2 or 3 years with some monthly payments. And we typically condition all these different payments and structures upon the performance of the business as well. Some of the ways we use are either setting it as a percentage of revenue, or sometimes as a percentage of profit of the business, or as conditioned upon traffic. So if the traffic stays stable, or if it does not drop more than 20 or 30%, and so on. These are some standard ways to set up an easy deal structure. And this allows us to reduce some of the risks, because with seller financing, with an earnout, we know that we are going to pay part of that acquisition price through the revenues of the business, through the future revenues. So we need to put less initial cash into it. With smaller deals, it doesn't really matter, but I would say with deals starting from about $50,000 and maybe starting from around $100,000 or so, most deals should have some sort of financing structure. I would recommend that, unless the seller is really bent on getting cash and you feel pretty comfortable with what you are buying. then of course by paying all cash you can get a better deal by paying less cash. But generally it's worth it. Especially the interesting thing is we found that in deals where sellers feel a lot more confident about the business when we do, that's then I always try to offer some sort of financing. And the way I would usually do it is just ask the seller, so how much do you think the business is going to earn in the next 3 months or 6 months or 12 months and so on? And they would give a number. And then we would say, okay, I don't have your confidence. Like, I'm not so sure that this is going to be the case, but as we will be managing the business, of course, we'll do our best to manage and grow it. So the deal that I would offer is, this is what you asked for, and what we can pay is actually a little bit higher total. But part of that payment is going to be conditional on the business performing up to those standards or close to those revenue standards. And in many cases, I would say even most of the cases, sellers would review that, and it's pretty reasonable because we are confident in the business, and they have, like, they know what to expect based on their experience with the business, and they trust us, so they know that they would get paid or even get paid more, and that's a good deal for everyone, and for us it allows us to reduce our risks as well. So playing more with deal structure is helpful. It's good. Finding deals can be more challenging now. I would like we still look at all the different places. We work with different brokers and marketplaces, and we do some outreach. But the best deals we find are usually the ones that come to us from our existing network, from people we've done deals with already, from people who they referred to us by our previous customers. These are always the best deals. We've been trying to do some outreach, so we often email some people that we think that they might be interested in selling their business and their business fits our criteria, but the response rate is pretty low, and it can be quite challenging to really find people who are motivated, who are interested in selling. So that's something we are still experimenting with, but so far most or nearly all of our deals have been coming through our existing network or just through some online marketplaces with where websites are listed. So again, to sum it up, how you find good deals: look for quality over price. First of all, look for quality, look for lower risks, look for opportunities of what you can improve in that business. And also look into deal structures that can benefit you and can be a win-win. Another interesting trend nowadays with the online businesses is the emergence of all the different funds. Funds allow you an opportunity to invest a small amount of capital into potentially a larger portfolio of sites. EF Capital is one of the more popular funds now, and they've launched quite a few smaller funds of 1 to 2 million or so through different operators. And while I think it's an interesting opportunity for investors, the downside is that 10% in EF Capital goes to EF. So from each fund, you right away lose 10%. And additionally, that there is a 15% that goes when you, that goes to EF, then the business is acquired, and another 15% goes to EF and the business is sold. And the operators currently are required to buy only from EF and to sell only via EF platform. So that's one of the reasons we decided not to participate. The platform is also quite competitive with many buyers, so we found it really difficult to find good deals there. However, it can be a very good opportunity to get into the market if you want to invest and see how that goes. And we've had many of our investors as well who invested in our funds, have invested with EF, and then they spread put like a minimum of 10,000 into different funds. My personal recommendation would be to prefer funds that are a lot more selective about the deals we buy, funds that are far more opportunistic rather than the funds that have more of a kind of index type fund approach that they say, I'm going to buy a bunch of this type of businesses and then, go and see what happens. Because that usually just doesn't work. In online business space, a space there, expertise is pretty much everything, and the gap between good opportunities and bad is huge. You can't be you can't try to have an index type fund strategy that's just ridiculous. You have to be very specialized, you have to be very selective, and you have to have some clear advantages and clear strategy. So for us at DM, our advantage comes from really understanding very well deals and due diligence and being able to find some of the best opportunities for businesses to acquire and strategies to grow, and also sticking to what works for us, sticking to sites with organic SEO traffic and things where we know we can manage well and we can grow. Many other funds have similar structure, similar setup. They usually specialize on some area. So if you are looking at how to allocate your capital, what funds you should invest, this would be my recommendation. First of all, of course, look at their history, look at their track record, but then also look at what is their strategy and what are their advantages. So that is very important. And also, the funds should have like a small portfolio, a limited size of limited amount of businesses that they are buying. And that's something we've actually learned on our experience now as well, which I'm going to tell a bit more about soon. So to sum it up, in terms of funds, look for more opportunistic funds that are far more focused on buying good deals and have clear advantages, clear strategy, and really good track record. Don't be swayed by promises or something fancy or something trendy. I would actually avoid funds that are going for something trendy. So I would personally avoid going to funds that just go for FBA businesses, because that seems to be the trend now. I would much rather prefer funds that specialize on acquiring businesses in some very, very boring industries, because those are generally the safer ones with good returns and lower risk, and risk is what really matters the most in profiting over a long term in online businesses. And ultimately, the old adage hasn't changed. You have to buy low and sell high, whatever market you are in, and we are in the market of online businesses. So the name of the game is just buying low and selling high, and it doesn't necessarily mean low in terms of price, but low in terms of opportunities and risks. So buying something there, the true value, once you've added some optimization, some improvement, implemented your quick strategies, is going to be a lot higher than what you paid. And that is a very important concept. And that is a true value after you've added in the perceived risks as well. So, and now let's go to the main Magnate updates. What have they been up to in this past year? Actually, quite a lot. We've restructured the company. So all of this past year, in fact, all this past 2 or 3 years, we've been pursuing a growth strategy, trying to expand and scale rapidly. And we got to about 20, 22 people in our team at some point at at the peak of it around the middle of 2021, and it wasn't working very well. I've realized that we needed more managers to get everything working well, and then we needed to provide a lot of training to all the new employees, and we weren't doing that well. We couldn't provide really good service to our clients. We weren't able to do all the things we planned for all the businesses we manage. So I've decided to scale it down, and I've realized that it was just not that scalable. The model that we had was not as scalable. The model of having more deals, more people, more managers, and doing everything sort of in-house and having all these different departments. We had a department for backlinks, department for content, all in-house, and tech department and a few other things. Because there was just a lot of logistics involved, and as you scale things, the bureaucracy of logistics scales exponentially, is what I've learned, unfortunately. And I didn't find a new way around that. I don't know if it exists. Maybe that's just what happens with all big organizations, that everything grows exponentially as the size of the company grows. So the decision I've made is to scale things down, and we got to about a couple dozen projects at that point, and like 20-23 people. So we went down to selling about half of our projects, and now we are down to only about 10 businesses in our portfolio, actually. And we have 10 staff as well, 10 people in the team, and several freelancers, several agencies we work with, but like the core team is 10 people. And that works much better. We are able to be a lot more efficient, really do a lot better job on our projects. And it's really difficult when you have a large number of projects. So in this past year, we have sold about 15 sites, and we've also basically let go of 3 or 5 sites, as in, but we were managing for clients. We simply had to let go of the clients. We explained that this is not profitable for us anymore. We've changed the model. We've done our best, and we've given them some recommendations to other people to work with, and that's it. And we've also acquired, we've done 9 acquisitions this year, acquired 12 sites in total, and there is 2 more deals in negotiation, which may complete soon or may not, we'll see. So if everything is completed, that would be a total of about $1.5 million in acquisitions this year. If those pending deals don't complete, it would be probably closer to $1 million in acquisitions this year. If the average size of the deal being around $100,000. And as we've planned for the 3 or 4 years ago, the plan that I had was to gradually increase the average size of the deal. That's what happened. So this past year, 2021, the average size of our deal was about $100,000. The 2 years before, 2020 and 2019, the average size was somewhere around 50,000, a little below, a little higher, 50,000. And before that, it was a little bit lower as well. And so now going into the new year, 2022, the objective now is to grow further, to go to average sizes of deals in the mid 6 figures. And we aim to acquire few deals now. I'd like to acquire maybe like 6 deals in the next year, only 6 businesses, but those would be bigger businesses that have values somewhere in mid 6 figures or up to low 7 figures. And that would allow us to really focus, and we would also reduce our portfolio further to be managing under 10 sites. Right now we have 12, and we plan to sell a few of them. We have about 4 that we are selling in next month or two, and then 3 more to sell in Q1. And that's a plan. We'll continue buying some, we'll continue selling some. On average, we aim to hold each site for about 2 years. I found that like 1.5 to 2 years is more or less what it takes to optimize everything and prepare for resale. And the bigger businesses might be up to 3 years or more. Bigger businesses meaning when they get to high 6 figures in sales acquisition price. And that's it. So we'll be buying few deals, but bigger deals. And we'll be doing it through, first of all, through our own capital at the main Magnate. And then we'll be using our group buys. So they now set up our first group buy just this past month. And then we plan to do some more subsequent group buys or more funds through which we would acquire those businesses. We've had good demand with that, but we've decided that we want to focus more on deals rather than funds. So we would raise capital, raise funds according to our plan and according to the opportunities we have to buy deals. So once we have really good deals, we would go and quickly send them to our list and raise the capital so that we can go and buy that really great deal. And I find that this would provide the best opportunities for investors because they know that how their capital is deployed. They know their capital is deployed into really good deals, and the capital is not sitting in a bank account for a long time. Like they know we would have a deal, and then we send out a request, we send out an email or a capital call, and people can send funds in a week or two, and then we just go and buy it right away. And then manage, grow it, and resell it, and then distribute funds or reinvest them in future acquisitions. That's the plan moving forward. We have also officially closed our first fund this year. You can find the update for the results of the fund on our website. If you go to the menu and go to invest funds and results from our first fund. So we've done a whole big case study on that. Our second fund is doing quite well as well. We only have 2 sites in that fund. Actually, we were planning to buy 1 or 2 more, but since we've stopped buying smaller sites, we've decided to probably just keep it at those 2 sites. So those 2 sites, they have grown quite a significant amount. So we've managed to increase the revenue. So we have started that fund in the beginning of 2021, that second fund, and acquired those 2 sites. And then we acquired the sites. We're earning about $5,000, $5,500 per month combined, the 2 sites together. And now that I'm looking at our data, the past couple months, they've actually earned close to $9,000 combined. So we've almost doubled the revenues and the values of the sites as well. So that one is doing well. We are also currently operating a few sites for our investors through private portfolios, through buy manage. Those are also doing quite well. We've managed to grow several of them quite well, doubling the revenues over the past year, or in some cases even tripling. One site, one of our best performing sites that we acquired actually late last year, that was a smaller website earning about less than $1,000 per month. And now we managed to get it up to about $6,000 per month in this past 3 months average or so. So we've had quite a few good successes here. We've also had a couple of SaaS businesses that did well. One that we acquired this year, and also we've managed to increase the revenues we've managed to increase the profit by about 25% over the past year. With SaaS businesses, the growth is usually slower, but it is more stable. And another SaaS business we acquired also about in the middle of this year. We've managed to actually double the revenues by improving the funnel and monetizing it a bit better. We did have a couple deals this year that did not go so well. We just recently sold our WordPress themes website, and that one did not do well. We actually lost a little bit of money on it. We recovered most of the capital, but lost a bit. So what we've learned is just not to buy WordPress themes or WordPress plugins related websites. Not because those are bad, just because those are bad for us. We are not experts in those areas, and they just require different types of expertise compared to what we have, and we mostly focus on organic traffic growth. So that's what we've learned. We've also learned not to buy smaller sites anymore, because often we just didn't have enough time among our team to do all the things that needed to be done for the smaller sites, and then the sites didn't grow as much as they could have, while a lot more time and capital was invested in the bigger projects, so those projects did a lot better. So that's it. To sum this up for what we've been up to this year, we've reduced the size of our team. We've restructured the company to really focus on fewer deals, fewer sites to manage, but higher average value of projects. And we'll be raising funds, raising capital more specifically for specific deals now. That's our plan. And focusing on buying bigger businesses and gradually increasing the range, the average size of business that we acquire. I still believe the best size of business is in 6 figures now, from low mid 6 figures up to like low mid 7 figures, which is the best range to be in terms of opportunities, because these are still sites, still businesses that are usually managed by one person, a small team. So there is not as much efficiency, and we can bring our advantages in monetization and in expertise in SEO to grow those rapidly. And they often have many unnecessary expenses, many different opportunities for improvement and bringing efficiency. So those are really great. And this is the range that we'll be focusing on in this next year. Next year is going to be exciting. And our objective is to acquire, like I mentioned, about 6 deals next year, more or less 6 deals, and probably invest about $3 million in those deals. And then we might also acquire, and we might buy a few bigger, like 1 or 2 bigger businesses above $1 million in value if we find really good deals, and maybe a few smaller deals as well to mix it up so we don't have all in the same range. What are some important lessons that we've learned this year? Interestingly, one of the biggest lessons I've learned this year is not to listen to most of the advice that is given. I have quite a large network. I know a lot of other people in the industry, so we often chat and I often ask for advice. And people love giving advice, especially in this industry of buying businesses. And many of my colleagues and contacts in the industry have big organizations, bigger teams, more profitable companies. So it's easy to trust them because they have seemingly more expertise. But what I've learned is that what works for them might not work for me and for our company. So it's really important to develop your own sort of sense of what's going to work and what's not. Develop your own expertise and really your own gut feeling towards the right business model. And basically just find what works for you and then double down of that. And that's what I've done so far, frankly, for the past 15, 16 years. That's what I've been doing, just buying sites and more and bigger deals. Now, after hundreds of deals, we are just gradually increasing it. So we are not jumping up. We are doing deals in low mid six figures now and looking at higher six figures gradually. So that allows us to reaccumulate experience and gradually move up, so that we are still quite comfortable in those ranges and those sizes of businesses. So really learn from your own experience and just double down on what works for you. It's my biggest advice for this year. And if you don't know yet what works for you, well, you have to experiment a lot. Also reduce the size of your portfolio. In this modern day and age, everyone suffers from that shiny thing syndrome, that they have so many different projects and opportunities that they are pursuing and considering and planning. And then in reality, people just get stuck in that planning phase and just don't have enough time, enough effort to put into the projects that they need to grow. So the best is always to have one business, one company that you focus on and put all your effort, all your focus into it. If you want to grow as fast as possible, just focus on one thing only. With that laser focus, you'll see the highest returns. And having a larger portfolio of sites is just not contingent with that sort of focus that is needed. Even if you have a bigger team, it's still challenging. So I would always recommend to, no matter how many businesses you have, how many sites you own now, reduce it. Don't try to grow it, but reduce it so that you can focus more. Also keep selling. It's important if you are in the business of buying and selling websites and keeping a portfolio, it's important to keep selling. Many people get into the habit of just buying and then they grow their portfolio, but they don't sell. And what happens is, if you don't sell, you lose that sense of what are websites worth. And that's why I often see people who come to us with completely unrealistic expectations for what they want to get for their website. And then also people often come to us once to sell once something goes wrong, once the website got hit by Google update, or once they haven't been managing it for like half a year and everything just dropped. So sell before you need to sell. Sell if you lose interest in the project. If you lose interest in your project, it's the best time to sell. And by the way, if you want to sell, just come to us, go to domainmagnate.com/sell, fill out a very short form, and right away we'll be able to get back to you and say, this is something, if your business is something that might fit us. You only have to enter the URL, business, the recent profit, and that's it. And that's usually enough for us to determine if it fits our criteria or not. And if it fits the criteria, we can quickly review, request some more information, take a closer look, and then give you an offer. And that will solve you a lot of headache and reduce the time and effort you need to spend in order to sell your business. So reduce the size of your portfolio. Next, what I've learned is that opportunistic approach, the market is still the best by far, because there is such an enormous gap between what's available in this current market with online businesses. There's such a huge gap between something that's a good deal and something that's not a good deal, something that's average. The gap in terms of future performance. So even if you are reasonably experienced at what you are doing and managing sites, if you buy an average business from marketplace, let's say buy Flippers or Flipper or whatever, versus if you go and find actually a good deal, like a top 5% good deals, right? The gap is just enormous. Like the average deal, you'll probably just lose money, and the good side, you'll probably like double or triple your investment with a good deal. And you don't see that in real estate, you don't see that in stocks most of the time, or in funds, in other funds. So this is quite unique for this industry, and that's why expertise play an enormous role. Expertise, having advantages in the industry, plays an enormous role in selecting deals. So opportunistic approach is still best. The time is spent reviewing deals, pursuing leads, and finding something good to acquire is not spent in vain. You'll learn a lot and you'll find something good eventually. So if you are still looking for a business to buy, don't give up. Continue looking. Also, what I've learned is that I'm not the best when it comes to managing people. While I'm improving in managing and hiring, I've also learned that hiring people, you have to either provide quite a lot of training. If it's someone who has not done that specific role before, they may have done something similar, but they haven't done this exact role, they haven't worked in this exact business space, then you have to provide a lot of training. That can be months and months of training and continually overseeing that, or find someone who actually has expertise in this specific exact business and they've done this exact same role, then that could work. And the mistake we've made is hiring quite a few people that had similar expertise from other industries or from slightly different roles and thinking that they would be able to adapt quickly. And I'm personally like, that's how I usually do things. I just like go into something new and then I learn it and I can adapt quickly. So I assumed, well, that's probably how it should work, but it did not. Most people need far more training, learning, if the role is different, even a little bit different. So that's an important discovery for me this year. And so what we are doing now is we make sure that we really hire people who have expertise in exact same thing that we are doing. So for example, if we are hiring someone to come and manage our specific content website, or go and manage like link building, we are going to only look for people that have been doing that exact role for the past couple of years successfully. And then we interview them, we ask them, show us examples, explain what you did at your previous jobs, what, and really have them tell us exactly what we've been doing. And otherwise we expect that we will need to provide them quite a lot of training. So that's really important. And so finally, the biggest thing I've learned is that this is a market with very uneven information and expertise. There is a lot of sort of gap of information between the seller and the buyer than you are selling a business. And so in markets like that, again, expertise and being more opportunistic and really doing a lot of due diligence plays a huge role. So to sum it up, if there is one thing that I want you to take away from this little episode, is that being opportunistic in this market really pays off. Find where your advantages lie. If you're looking to buy a business, find what you can do better than most other people. Figure out what type of business suits you best. Could it be content side, some kind of technology heavy business, something that's logistically heavy, or e-commerce and so on. look what are the traffic channels that you can be managing well, that you're good at, and then look for good opportunities with those parameters. And learn more, and start small. Always start small, buy a smaller business first, and then as you feel comfortable managing it and growing it, go and buy a bigger business. Thanks for listening, and if you enjoyed this episode, please share it with just one friend.
Domain Magnate is a leader in buying and selling online businesses with a proven track record of expertise gained from over 300 deals since 2004. To learn more about how we can help you acquire or exit a profitable online business today, head over to domainmagnate.com for more details.